long, got to keep. But now everybody knows, got to keep.
You don't have to be retired to receive tax-free income. The problem is the vehicles that we've been conditioned to believe to help get us there were never designed to produce income.
Got to keep going. What you want to be going, you will see. It's your destiny, be in harmony. We were never meant to be apart. What you want to be going, you will see. You can have everything you want. It's your destiny, be in harmony.
If you had a machine in your garage and all you had to do was put a quarter in it and it printed out $100, a quarter in it, printed out $100, would you ever stop that machine from running?
But now everybody knows.
So what if you use that job that you hate as leverage to fill your machine so they can create income for you, so you don't have to worry about income?
Where the world is gonna go. But now everybody knows that you can't stop for too long. Got to keep going.
Good evening. Welcome back. We hope everyone had a wonderful weekend. Hope you're well rested and you're ready to learn something that there's a whole slew of people who are looking this up right now. We had about 10 comments on the blog that we have over on sdretirementplans.com asking, how the heck can I take advantage of this? And does my particular situation apply to this? How can I use this? What are they at? What are they talking about? They're asking, how can I use this gifting? What are the tax exemptions? What are the tax advantages of doing this? How can I avoid paying taxes on this? Is it truly tax-free? They want to know, how much can you gift with your IRA? Gifting an IRA. Now, we've heard of taking out a personal loan. We've talked about that here on this channel. We've talked about how to leverage it in many different ways and how to structure that IRA so that you can invest even in non-traditional investments. But we have not talked about this part right here. These are some of the secrets that are kind of like loopholes that other people have been using for a very long time. But why haven't we? Right? Why haven't you? And if a loan is your first go-to, and depending on what you're using it for, you may want to tune in because you might learn something today that'll rock your world. This is IRA Gifting 101, right? Okay. So we did have a lot of comments on the blog. That's a given. And we went ahead and addressed those anyway, but we thought this was just an opportunity for everyone to learn together around this subject. We have 20 years of content over there on our website, blog content. And what we really appreciate is that how many people find our content over there helpful, especially in regards to how to leverage, take advantage of, or learn how to use your IRA before or after. I guess there's a lot. You guys cover a lot over there. Retirement age. So for I guess for the purposes here, we do a lot of content around how to retire early. Our goal is not to help to make you wait until you are 59 and a half, certainly not any older than that. And so that's why it's important to understand how to leverage it.
Yeah, there's so much here, because in doing the research and kind of walking through how we were going to present this, what I learned is this is actually what we're seeing those who are at retirement age, those who are receiving retirement dollars, we are seeing them wanting to be able to assist, support, help generations now while they're still here. So this is less about estate planning, and it's more about, hey, how can I assist my loved ones now and use some of this retirement income that I have to be able to do so. So I think that's a pretty awesome aspect of it, because it's less about I'm trying to hoard, or I need this money for me. It's no, you know what? I'm actually trying to be of service, be of support to my family members, to other charitable organizations. How do I go about it, and how do I go about it effectively? So it's a pretty awesome, I think, position to be in if you're in that position. And I think it says a lot about the individuals that have been asking, because ultimately all they're trying to do, all they're wanting to do is be able to support.
Yeah, well, that's true. But not having this information or access to this information could have you making different decisions as well. For instance, some of the people who were writing in were wanting to know, can I use this to help my kids buy a house? Like, can I gift them money to be able to use as a down payment or for whatever it is that they need it for?
Right.
If you don't understand or even or are even aware that you can use this strategy, how would you go about that, right? How would you structure that? That would come out of savings, that will come out of somewhere else, that might even be a loan that you would take and end up having to pay back, right? Pay interest on. There's something about this though that I actually don't agree with, and I don't feel is a good. So this is a good strategy for some people. It's really good information to know. But there is something here that I feel like is missed with all of the hype around gifting your IRA. Doesn't matter what the rules are for 2024. Doesn't matter what all of the intricacies for this strategy or the tax advantages of doing something like this. There's still something out there that I feel is being missed, and I'll save it to the end.
Uh-oh, I'm excited. Cliffhanger. Dun, dun,
Yeah.
dun, dun.
So get in here. I hope you guys are ready to learn something new. Please put a Q in front of your question, and we will start loading them into a queue for the Q&A when he's done here. And we tried to make it quick so that we aren't taking forever, all right? So we're trying something new. All right, you ready?
Yeah, let's jump in.
All right, let's get into it. How much can you gift with your IRA? Let's find out.
And I think the truth about this entire, I'll call it live for today, this will move pretty fast because it's not what you think. Meaning, a lot of people have this impression of how your retirement dollars can be used and how it can't. And so, what I wanted to do is first kind of break down this gifting piece, because don't confuse gifting and gifting requirements, gifting rules with how gifting applies to your IRA, 401k, 403b, TSP. Again, those are two separate things in most cases, meaning there are gifting strategies, there are gifting rules, there are gifting tax exclusions that we're going to talk through. But in addition to that, when you have a retirement account, when you have qualified dollars, they have their own set of rules. And a lot of times the two don't talk. So we're going to kind of dig into some of those details. So kind of starts out with, what are the 2024 gifting exclusions? Like, what are they? And this has increased over last year, because I think last year was 17,000, if I'm not mistaken. But this year, the gift tax exclusions are, you can gift a dollar amount of $18,000 or less and not have to account for it, not have to pay a gift tax. But the minute you go over that $18,000, it will be a taxable amount. Now, if you are at retirement age, or you're wanting to be able to gift larger amounts to a qualified institution, you are able to gift up to $105,000. And just so we're clear, this is actually per spouse. So again, let's say I wanted to gift one of our kids $18,000, and my wife also wanted to gift one of the kids $18,000. We can both gift $18,000, and neither one of those amounts are need to be accounted for from a tax perspective. Now, we may still have to fill out a 1099-R to account for the amount, but there's no gift tax associated. And then if we go above that, then obviously there is a tax. And that goes the same way with the total, the 105,000. There's a total of $105,000 per year that can be gifted, and as long as we don't exceed that $105,000, the amount that's being gifted there's no tax implications on that as well, and that is also multiplied by 2. But the piece that I want to make sure is clear, and most people don't realize this, there's a lifetime gift tax limit. And so what's happening is as you're gifting dollar amounts to your kids or gifting dollar amounts to family members or to charities, there is a total amount, there's a maximum that you can gift throughout your lifetime. And that maximum continues to increase. Now, most of us, if not all of us, um, will not necessarily come even close to that dollar amount unless we're some type of philanthropist, making money somewhere around the range of Jeff Bezos or Bill Gates. But the bottom line is that maximum is right around 13.61 million. I think it's up from 12.9 million over last year. So it's increased as well. But now, again, don't I'll call it confuse the gifting tax exclusions with IRA gifting. This is different. Meaning, what we're talking about is can you gift from a retirement account? Can you gift from a qualified retirement account? And notice this says, what is IRA gifting? This is specifically talking about IRAs. But what about a 401k, a 403b, a TSP, a government 457 plan? Can you also gift from those? And in most cases, you cannot. But that's really simple to solve. You just simply transfer those funds from the place that they're in, even if it's a self-directed 401k, you can transfer those funds into an IRA and then gift from there. But the gifting rules from an IRA are different than the gifting rules from a just the general gifting rules that you're able to participate in. And so traditionally, any gifting that's being done from a qualified IRA, meaning a qualified retirement account, like an IRA, individual retirement account, it has to go to a qualified charitable, it has to be a qualified charitable donation or a qualified charitable distribution. I'm sorry, qualified charitable distribution going to that entity. So where can you gift from or who can you gift to from an IRA? It has to be a charitable organization that qualifies. Notice I didn't mention in there that you can gift from your IRA to your children. You can gift from your IRA to friends and family. You cannot. You can gift from your IRA to a qualified charitable organization. That's what it boils down to. And also know this, you have to be let's grab that. You have to be a certain age in order to be able to um, provide a charitable distribution to that charitable organization. So you have to be at least 70 years, 70 and a half years of age in order to be able to make a charitable distribution to a QCD. Now, in addition to that, if we're talking about a traditional IRA, not a Roth IRA, but a traditional IRA, any distribution you take from an IRA will be taxed. But if the goal is to avoid that tax, then you can contribute up to, or you can make a contribution, a charitable contribution up to 105,000. So the limit is still the same 105,000 that the general gifting rules apply to. You can gift up to $105,000 to a qualified organization and not be impacted by those taxes. But again, the rules are different. 70 and a half years of age, up to 105,000 to a qualified charity. Again, I did not mention, nowhere in here does it state family. Why? Why is that? Why is it that you cannot gift from your qualified retirement account to a family member? Well, it's because your IRA, your 401k, your 403b, your TSP, your government 457 plan is designed for what? It's designed to support you through retirement. And because it's designed to support you through retirement and also your beneficiaries if something were to happen to you, because it's designed to benefit you, it cannot be used to support anyone outside of you and your spouse. If that does happen, you are committing what's called a taxable event, taxable and sometimes penalizable event. But why? Why is this even a thing? Why are we having this conversation right now? Why is this even coming up? And so I just wanted to highlight a few numbers. And this is related to baby boomers and the silent generation. We are in the midst of the largest transfer of wealth in history. By 2025, they're expecting $84 trillion to be transferred from baby boomers and the silent generation. And of that 84 trillion, 72.6 trillion of that is going to be passed down to heirs. So what's happening is these guys got a lot of money and they're realizing someone is coming for it. Again, these are traditional retirement accounts. The government is realizing that, hey, here's an opportunity to make up for some of the ills that we have within our system, within our economic system right now. And they're expecting a large taxable benefit coming from the baby boomers and the silent generation. And they see it and they see it coming. So they're trying to figure out a way, how can I avoid paying those taxes? How can I avoid paying those fees and not be impacted by this large I'll call it large taxable event that's going to happen inside of my retirement account? Is there a way I can reduce that taxable event by giving some of this money away? I'd rather give it to my family. I'd rather give it to a charitable organization than give it to the government. So the reason we're even having this discussion, the reason there was so many comments on our blogs, the reason I've gotten a fair amount of calls related to inherited IRAs and can I transfer money from my IRA or 401k to some of my family members is because of this transfer of wealth that's happening. There's a lot of money involved here. And the objective is, hey, how can I reduce and or eliminate those taxes? There's just rules that we have to be aware of in order to make that happen. So can you? In some cases, yes, but in a lot of cases you cannot. And again, why? What is the purpose? What is the point of your retirement account? The purpose of your retirement account is strictly to support you through retirement. And again, we talk a lot about IRAs and 401ks on this channel, specifically self-directed IRAs and 401ks. And there are some rules that you have to be aware of. One of them, one of the key rules is disqualified persons. There are certain people that can't come in contact with your retirement account. And that straight line of individuals are they. And so therefore, a large part of this is, hey, I've got people calling me saying, hey, how can I not just avoid the taxes and fees, but also how can I get outside of that disqualified person rule? And the short of it is you can't. Go ahead, sweetheart.
Oh, real quick, I just think that it would be valuable to talk about why this exists in the first place. Why the why the IRA was created and who it actually serves and why this particular structure is in place. I might have missed you talking about it, but I don't think you did. Did you?
So, well, at least I thought I did. But the bottom line is why this exists. This is thought to be a tax shelter for you, but it actually is a bank. It is a compound interest producing machine for the government.
Yes.
Meaning the objective here is they know you've been putting away these dollars tax deferred for years, and they see the light at the end of the tunnel. And now that you've hit 70 and a half years of age, you are approaching that RMD age. That RMD age is 73. They know at that RMD, they're going to start getting some of that money back. That investment that they made in you, this compound interest producing vehicle that you thought was to assist you in retirement, is actually going to support our economy. And so they're expecting that return coming pretty quick.
Yeah, it's that part. And a lot of these traditional systems were set up for that. That's why they agreed to it in the first place, is this safeguard for them, right? Especially against inflation. So a lot of people who are saying, I'd rather pay the taxes later. This is why they thought, wouldn't you want to pay the taxes later? Because you're going to end up paying more. So not only has inflation robbed a lot of these accounts anyway, the amount of accounts on accounts. So if the person who you had got the transfer from may have had it transferred from somebody else, right? And so these continue to roll over, but it doesn't matter because they continue to siphon off taxes from these. That's the part. Why did these exist in the first place? So the rules of these accounts, these vehicles, those are separate from why, like what the initiative is, what's the goal, who benefits. So that's partly why I wanted to bring this up. Go ahead.
I'm with you. And so what are those rules? Speaking of rules, what are those rules? What are those IRA gifting rules? Well, you first have to be old enough. Meaning, in order to make a gift from your IRA, you do have to be at that 70 and a half age. But what if you're 59 and a half? What if you're at the age where you can take those taxable distributions? Well, that's where you can take the taxable distribution from your IRA, right? You can It doesn't have to be an RMD. You can take that taxable amount, because again, it is going to be taxable if we're talking about an IRA, but then gift that dollar amount to whether it's a charity or a person up to that $18,000 mark, where you won't be impacted by taxes. Who you're gifting to matters. Again, if we're talking about family and you're wanting to be able to use your retirement account like an IRA, you cannot gift from your IRA to your family directly. How would you do it indirectly? Again, you would take the taxable event. Again, you would withdraw cash, you would withdraw income out of the IRA, and then you can gift the cash up to that $18,000 mark and not be impacted by have any tax implications. But if you're at 70 and a half, you can then contribute up to that 105,000 to any charitable organization. So anything from 0 up to 105,000 to any charitable organization and not be impacted. But again, you have to be 70 and a half, so that age matters. And then understanding the I'll call it the governing body, understanding the rules and regulations inside of your retirement account. They are not all created equal, because notice what we're talking about here. We're talking about an IRA. Nowhere do you see the words 401k. So can you gift from your 401k in any based off these rules? You cannot. A 401k is not. A 401k is a pension plan. So how do you do it? Well, you would have to move those funds from a 401k into an IRA, which is a penalty-free, tax-free transfer. It's very easy to do. It's not hard at all. But the moral of the story is you can't just directly gift from your 401k. And lastly, who you're gifting to matters. Who that family member, who that charitable organization is, that charitable organization set up properly, and that's kind of where this section comes into play. So once funds are in the IRA, there are a few requirements to make sure you're able to get that tax break. You can donate to as many charities as possible. And again, I updated the numbers up to 105,000 and 210,000 between you and your spouse. So you and your spouse individually can contribute up to that same dollar amount. And then the checks must be made payable to the charities. And the charity themselves must be 501c3 public charities. So who matters, and how the checks are made out matters. And you must be, again, 70 and a half to be able to donate. And if you have made, this is a piece that most of the clients that I've talked to who are in a position to be able to do this miss this part. And I'll summarize it. If you're 70 and a half and you're still contributing to your IRA, you can make the charitable contribution, but you will owe taxes on the amount that you've contributed into your IRA. You will owe tax on that dollar amount. And once you've paid that tax on that dollar amount, the remainder is then still receives the tax deferred or tax-free benefit. So again, if you have made deductible contributions to your IRA since turning 70 and a half, those contributions will cause the donations to be taxed until those post 70 and a half contributions have come out of the account. So what that means is if you're 70 and a half and you're still putting in your $8,000 a year and you're wanting to make a charitable contribution of $20,000, well, $8,000 of that $20,000 charitable contribution is going to be taxed, because it's going to basically cancel out the deferred dollar amount that you've put into your account. So if you're no longer contributing at 70 and a half, you have nothing to worry about. But if you are still contributing, that's something to take into consideration. And then just kind of restating this again, we've kind of already gone over this slide, but I just wanted to restate it again. Under $18,000, if you're making a charitable contribution from your IRA under $18,000, it's not taxed over, and you have up to that $105,000 to a qualified charitable distribution can be made up to that $105,000 mark, you're fine. But if you're wanting to make something like this, that $18,000 gifting dollar amount to a family member, you can do it from your IRA, but how? You would have to take the taxable distribution from your IRA, meaning you're going to withdraw $18,000 or maybe something larger than that. I guess if you're going to end up paying taxes on it, probably more like $22,500. You're going to withdraw $22,500 from your IRA, pay taxes on that $22,500. After you pay taxes on that $22,500 or the taxable amount on that $22,500, the result will end up being right around that $18,000. And then you can gift that $18,000 to whoever you would like, whatever family member you would like. And you can do, then from that point, they can do whatever they want and you not have the tax implications. And again, just making sure this does not impact, or these dollar amounts chip away at that total amount that you're able to gift. And that's about 13.61 million. And as we always do, I wanted to highlight an example. And this is a real world example based off a conversation, or based off one of the comments from the blog. Go ahead,
Yeah.
sweetheart.
I'm going to go ahead and read it because I think it gives it context. So this person wrote in and said, my husband and his brother inherited an IRA from his deceased mother, but only the brother's name is on it. He doesn't want to take half out to give to my husband because he says he will have to be in a higher tax bracket. Although we would have 20% tax taken out, can he just cash out half of the money and give us a 1099 form without it affecting him?
Yep. So again, deceased parent trying to do the right thing. And I love the visual here, because how many of us are in a similar position where 9 times out of 10, we're going to put the onus on one of our kids with the expectation that that one child, that one kid that we put the responsibility on, they're going to take care of things for us from there. They're going to kind of do our bidding or take care of our wishes from that point forward, and take care of their siblings.
And
so
he's probably the oldest too.
Absolutely. So I fully respect what mom was doing, but again, this is where education matters. This is where understanding the rules and how things work and what that impact is going to be, because the actions that you take today could be setting up generations to be impacted by some decisions that you didn't realize that you were making and what that impact would be. So she was doing the right thing from her perspective, right? Hey, I'm going to gift, or beneficiary is the word I'm looking for. I'm going to make the beneficiary of my IRA that I ended up not spending all of the money out of. I'm going to make the beneficiary of this IRA the oldest.
Yep.
And it's his responsibility to make sure he equally shares this dollar amount, this inherited IRA, with his brother. Can you do that? Can he just, on his own accord, split this IRA in half and then give it to his brother? Can that be done? Cannot. Why? Because this is a qualified retirement account. Qualified retirement accounts have their own rules. And what was that first rule that we talked about? That was down at the bottom of that slide. And it was this: what is your retirement account designed to do? It is designed to support you through retirement and your beneficiaries if you end up leaving it to someone. Meaning, because she made the oldest the beneficiary of this IRA, the IRA belongs to the oldest. And if he were to just simply take half of that IRA and provide it to his brother, that is a taxable and penalizable event. And so the request was, hey, how do we split this IRA the way mom asked us to do? How do we split it, but it not become a taxable event for our oldest brother? And also, we want to be able to check the box and satisfy mom's wishes. How are we able to do it? And the short of it is, they can't without incurring taxes. Because, as we talked about earlier, what's the whole point of deferring your taxes? We've been educated to believe the whole point of deferring our taxes was to help and assist us in retirement. But in truth, what we've done is we've created a compound interest account for the government, and the government wants their piece. And so in order for any distribution to come out of this IRA, it is going to be a taxable distribution. There's no way around it. So if he wants to end up taking half, let's call it $100,000. Let's say there's $100,000 in this inherited IRA. If he wants to move $50,000 to his brother, there's going to be a taxable event on $50,000. Now, there won't be a taxable and penalizable event, but there is a taxable event on that $50,000 headed over to the brother. So is there an easier way? Is there a better way? Is there something else that can be done here? Because this is the result. This is again, based off the current structure. And I don't have all of the, I'll call it visibility into how the IRA is structured. But if this is a traditional IRA that has been inherited from another individual, the structure started here. Just because he's inherited, he can't change the structure of this IRA. Meaning he can't make any adjustments the best thing that he can do is take a distribution. And how about this? If mom passed and she was already receiving required minimum distributions, the minute, not the minute, it's a year after. He has a year before he has to start taking those same required minimum distributions. So if it's required minimum distributions coming out of this IRA, it's going to be a taxable event, and then he can provide his half to his brother. Well, ideally, if they were looking for some solution other than that, the best thing that they could do is use the gifting option, meaning I'm going to take a withdrawal of at minimum $22,500. Why $22,500? Well, assuming a 20% tax bracket. If this brother was to take a $22,000 withdrawal out of the $22,500 withdrawal out of this IRA, pay the taxes on 22.5, the result would be 18,000. He would then be able to gift that 18,000 to his brother. And if I'm the older brother, then what I would expect is out of that 18,000, 50% of that taxable amount, so 22.5 minus 18,000 is 4,500. So half of 4,500 would come back to the brother out of that 18,000 that was distributed to him. To me, that's the closest I can get to a way to not avoid the taxes, but reduce the tax burden. So instead of paying the taxes on all of the money inside of this IRA, you take small withdrawals, pay tax on the small withdrawal, and the withdrawal being less than the charitable limit, and then you gift that dollar amount to your brother. And so you pay the least amount of taxes possible. But again, Uncle Sam's going to get theirs. But that to me was I'll call it the most efficient way to being able to satisfy mom's wishes. Ideally, and there's a lot of context involved in this piece, but ideally, this is how it should look. Ideally, it would have been great if mom would have created a trust. And in that trust, she would have laid out her wishes. And in the midst of laying out her wishes, the beneficiary coming out of that trust of this IRA would have been both brothers. And again, if she was already taking required minimum distributions, then those required minimum distributions would have gone between both brothers. And as they take withdrawals, Uncle Sam was still going to get his. Meaning, as they take me and my left hand, as they take the required minimum distributions that they were expected to be able to take, or if they wanted any dollar amount, they would still end up paying taxes on that amount that they ended up taking as a withdrawal, because it is going to be a taxable distribution. And so Uncle Sam will still get their part. There's really no way around that unless this is a Roth IRA. This is a Roth IRA. There's no taxable event, because the money was growing tax-free. But in most cases, what I'm seeing, because we've been conditioned to believe being tax deferred works in our favor, because we've been conditioned to believe that, most of us, most of our parents, most of our grandparents, most of the people who are sitting in this position with this wealth that are looking to be able to distribute, it's all tax deferred. And so there's really no easy way to go about this, but there are some actions that can be taken. Some actions. Go ahead, sweetheart.
Well, before you move on to the next thing, we had a question about trusts in the chat.
Okay.
Antonio was asking, if you structure this through a trust and you have your own charity underneath the trust, can you gift to that charity up underneath your trust? Antonio, correct me if I'm wrong, but I think that's what you were asking. And there are quite a few people talking about that, just in terms of securing that family bank style structure and being able to double dip essentially on some of those factors, because now you can assign your kids or your spouse or whoever in your family to that charity, president of whatever that is, and funds can be utilized in a different way.
So this is where I appreciate you putting the ticker down at the bottom, because I'm not a tax attorney. I'm not a financial advisor. This is not financial advice. And this is where you start skirting lines or walking fine lines as to what you can or cannot do. But let's start here. We talk a lot about having traditional retirement accounts, self-directed IRAs, self-directed 401ks, and there are certain rules that you have to abide by. And the number one rule is the disqualified person. So let's just think that through. I've got an IRA, and I want to be able to transition that IRA to my own charity. Who's the number one disqualified person? Me. So, can a charity that I am the chairman of or that I am a member of receive this charitable donation from my retirement account? Again, there are lines here that are being crossed that you can find yourself in some pretty severe situations.
But
However, go ahead.
there are loopholes that people are using all over the place. And
That's where I'm headed.
if you don't know them, then you're sleeping on some opportunities, and which could end up costing you, which is why these loopholes exist.
Yep.
Because the ultra wealthy are able to slip right through them and reduce their taxable, not create taxable events, reduce their taxable income, and avoid paying taxes altogether in some cases.
And that's where a trust and a trust can be a different type of trust. Meaning the type of trust you have, the structure. This is where this channel focuses heavily on structure. How your trust is structured matters. There's this thing called a charitable remainder trust, CRT, charitable remainder trust. And again, this is not something that I can even offer or provide. It's just something that I happen to understand. And that is, let me break down a scenario. So if the goal is, hey, I want to be able to take full advantage of the dollars inside this trust, I want to make sure there's no tax implications, whether we're talking about assets as in land or real estate, or we're talking about crypto, or we're talking about any type of asset, that I want to make sure there's no tax implications on the individuals who are the recipients of those dollar amounts or those assets in that trust. Well, there's this thing called a charitable remainder trust. And what that means is, hey, we're going to identify a charity, not my charity, not a charity that I own. We're going to identify a charity that does not cross any of the disqualified person's lines. And we're going to make that charity be the end result of whatever the remaining assets, remaining dollars are inside this trust. Again, charitable remainder trust. But here's what the charity understands. They understand that it's going to require everyone associated with this trust to pass before they receive any of those dollars. So what you do as the owner of the trust is you go to that charity and say, hey, what if instead of you waiting for my entire lineage to pass before you receive the remainder of this trust, what if in place of you waiting, we provide you with a cash donation of a dollar amount? I'll just make up one. Let's call it $30,000. Name your favorite charity. Do you believe your favorite charity would see it as a benefit for them to be able to receive a $30,000 donation today? Not wait 50 years before your lineage passes, but
Right.
as of today, they're going to receive $50,000. Do you think they would see that as a positive? Of course they would. The only caveat is, in the midst of them receiving that donation, they sign over the rights of said charity back to you. So what you've done is you've not skirted any lines as it relates to disqualified persons. You've identified a charity, and the charitable remainder trust, that charity is going to receive that dollar amount. But what they've done is they've signed over those rights back to you as the owner of the trust. And so now what that means is you have full control over that entire process. Now, this is not you can't just walk into your favorite lawyer's office and create a charitable remainder trust. There's steps, there's processes, there's structure, who you get it from, how it's designed, what it's designed for, what those rules are, what the vehicles inside that trust are, like the type of retirement account, IRA, 401k, 403b, TSP, all of that stuff matters. But my point is, to your point, sweetheart, there are ways to skirt a lot of these rules. but you have to understand how in order to be able to do so. So if you or anyone you know might benefit from a trust properly designed to be able to take advantage of some of these things, I would just suggest you put time on my calendar because it's way too in depth for us to go into here. The moral of the story is, if there is a way, the moral of the story is there is an option for you if this impacts you from that fashion. So is that what you were expecting, sweetheart?
Yeah, Antonio says Warren Buffett and Bill Gates have done exactly what you just pointed out.
Mm-hmm.
There are, Rob has a question. So should we book a call for Donnell to share those secrets, loopholes, laugh out loud?
And here's the thing. What I love about this is, so we are continuing to evolve and grow as well. There's these 5 or 6 different things that we talk about as far as how our machine is structured. Well, as our machine evolves, as income is generated, we have to add different pieces to our machine, one of them being a trust. And so the first step is to vet and properly add to our system, our machine, a trust that can sustain or support our lineage. That's number one. But then, to your point, after that becomes the charitable remainder trust, there are these advanced strategies that we are headed towards only because that's kind of what is required in order to be able to hold on to all of your money, right?
Well,
So go ahead.
sorry, go ahead and finish your
No,
thought.
no, I think I was done there. My point is, so you're absolutely correct. There are these strategies and loopholes that we are also in the midst of learning as well. So I'm hopefully you guys are on this channel because you're taking this ride with us so that you can also participate.
This is why, though. What's happening with this family? Someone in the chat also said that their family is experiencing the same thing, and it's because we just don't know what we don't know.
Right.
Therefore, this mom in particular, in this example, pointing the wrong direction. This example, she just assumed that, you know what, I'm to keep it clean so that there's not a whole lot of red tape in her mind. She thought, let me just put one person in charge of all of this, and then they can distribute whatever needs to happen to make sure everyone's taken care of, because I feel better about that.
Right.
The problem is he can't just make things happen because he's going, hey, my mom told me to do this.
Right.
My mom told me to split it with my brother, and so I'm just trying to do what she told me to do. There's so much red tape. Sometimes, though, this is not just what the IRS or Uncle Sam is getting in the way to make things worse for you or to take more of what that legacy or that inheritance should have been, right? Sometimes this is, oh, we weren't set up properly, and now we didn't even know what probate is until we got to this point, and now everything is on the line because we don't have access to the funds, and in addition to not having access to the funds, we can't leverage them to fight this in probate. So there are all of these vultures. You thought that house flippers, right? You thought they were bad when it comes to somebody going through a foreclosure. They are like right there, ready, parked out front, ready to take over the house and flip it out so that they can make some money. They do not, it's not personal for them. Neither are people who go after probate estates or estates in probate. It's very much the same thing. This is why we have to get structured and we have to learn and educate ourselves so that we can prevent this from happening. A lot of people are making the assumption that just because they built it, they get to keep it or they get to pass it on. And oftentimes that is not the case. Most families, most kids do not want your business. They may not want your home. They may not want your things. They may not want what you think is valuable because it was valuable when you started. We just have to take inventory and start in a different way. We also recognize that it is not just passing on the wealth. It's also ensuring that that wealth will continue to grow. And that's what I'm talking about that is missing out of this equation is, well, a lot of people are focused on gifting so that they can avoid paying taxes. But what are they missing truly when they're so focused on how to not pay taxes, so focused on deferring taxes? This a small amount of money, when you really look at the big picture, that's the part that's missing here. And I'm going to point it out as soon as you're done with these examples. So go. I'll let you continue.
Okay. So, and we're pretty close to being done as well. So the bottom line is there a better way? Is there a way that your IRA or 401k can be transferred or provided or given or become a tax-free gift to a loved one? And so I just wanted to highlight a few of these, because there's a few different ways to go about it. But the first step is you got to understand the rules. You got to understand the gifting rules. And so what that means is just because you have a retirement account or just because you're wanting to be able to gift dollars, you have to understand how and when that's even possible. So it starts with knowing what are those limits. That $18,000 and greater, that means you're going to create a gifting tax. Who is responsible for that gifting tax? Meaning, if I'm actually going to gift 20,000 versus 18,000, who is the one that's going to pay that tax? Is it the person receiving the gift or is it me? And because most people don't know know the rules well enough to understand where the responsibility is even sits, and it actually sits with you, the person gifting the dollar amount. And ultimately what that means is you have to 1099R for the, or I think it's R, 1099R for the amount that you're gifting. So understanding the rules matter. In addition, most people don't realize this, but you can convert your retirement savings into a life insurance policy. I went back to the rules. If you remember the rules related to IRAs and 401ks, we talk a lot about there's three things you cannot invest your retirement dollars in. It's S Corp shares, collectibles, not to be confused with precious metals, but collectibles like antique paintings, antique cars, baseball cards. But the other one is life insurance. You cannot invest your retirement dollars into life insurance. So how do you convert your retirement savings into a life insurance policy? Well, it's actually pretty simple. It's you're taking distributions from your retirement account, from your IRA, from your 401k, and you take that distribution, very similar to that example that we had mentioned. You take a distribution in the amount of just under or just at the gifting limit, call it $18,000, and you take that dollar amount that you've paid taxes on, that $18,000 you paid taxes on, or 22.5 that you've paid taxes on, and take that 18,000 and contribute it as premium into a secure compound interest account. Because what you're now doing is you're now transitioning those retirement dollars, you've paid taxes on them, so there's no tax implication there, and you've now moved them into a vehicle that is growing tax-free. And if you give your money the right amount of time, it can actually become a generational wealth building tool that's being funded from an IRA and or 401k. And this one is going to sound kind of I'll call it, sounds kind of bad, but it's true. And that is, if we're focused on how do you make sure your IRA or your 401k is being gifted tax-free to your loved one, well, if you set as a beneficiary, whether it's an IRA or 401k, you set as the beneficiary your kids, you are transferring that vehicle with no tax implication to you if they are inheriting it. Now, that means they're also inheriting the tax liability of that dollar amount, but it is a tax-free gift, meaning setting the proper beneficiary to your family creates a tax-free gift.
Okay. I'm coming back in to say this because
Go on.
I don't know his name, but the oldest here in this situation, his number one concern was, look, I get that mom did this and I understand that you need access to your inheritance. I get that part, but you realize the position you're putting me in.
That's
In order
exactly
to
what
get it for you, I have to now pay more than you do, more than you would even if your name was on it. I'm penalized for this. Like the way she set this up means that I'm going to get reamed with taxes because now I'm in a higher tax bracket and I can't afford this. So
Theoretically, meaning, is he in a higher tax bracket? You're correct if he's in a higher tax bracket.
that's what she wrote in and said. That was
Right,
his
right. No, I'm
concern.
saying this example, you're absolutely correct. I'm just saying that's not the case for everyone. That's all.
Okay, well, how about this? You're trying your best to utilize tax strategies, whether it be depreciating assets, that's my word of the year, or it's some other tax strategy to reduce your taxable income. And you've done a really good job and you've gotten yourself into a situation where you understand and you're aware of how much you're going to be paying in taxes, how much you should owe in taxes. So you're comfortable. You know that the second that you get bumped up into this higher tax bracket, you're going to pay more. So the amount that you are adding here could mean you're actually not adding very much at all, because when you're right at the bottom of the next tax bracket, it's almost as if you didn't make any more money at all just because of the increase in taxes overall. It's very unfair for those who are just barely getting into that next tax bracket. They end up paying more in taxes, but they have less income to show for it. So that part is frustrating for a lot of people. Uncle Sam just wins regardless in that scenario.
That's the part. And I think, you know what, we could probably do a whole live on the impact of deferring your taxes,
Okay, well,
because we
yeah.
very rarely talk about this side of the problem in deferring your taxes over time. And
Right.
again, for your financial advisor looks at it as a positive. Your company that you work for views it as a positive, not really talking about the impact, when it comes to fruition. Go ahead.
Here's the part though. If she was already taking distributions, if she was already at retirement age and she is now or forced to take distributions, now he will be forced to take these distributions whether or not he needs it right now, right? So regardless, his income has just increased, which could mean if he can't increase his income enough into that tax bracket for it to make sense, it's just getting eaten up.
Sure.
There's no point. There's nothing to show for it. So yeah, sure, I can gift you what mom said to gift you, but do you realize that I'm getting nothing out of the deal? So I'm giving you because I'm trying to do my part. I'm trying to make good here. But the truth is, what you're not seeing is that how this is structured is so incredibly flawed that I end up with no inheritance because I'm just paying the taxes for you to have yours. That's mine. Thank you so much. Love that for me. And that's the frustrating part, which ends up, even though this was supposed to be generational wealth, even though this was supposed to be the inheritance, the legacy, all of those things, somebody didn't care enough to do more than the surface math and more than the surface selling to explain to her how to set this up in the long run, because it didn't benefit them. They are not tied to the outcome. I know I rant about this stuff all the time, and I really tried to reduce my ranting about this stuff. But this is why I feel like I have to get out here and bang and pound on this drum, because there are a lot of people out here who are focused on being debt-free. There are a lot of people out here who are assessing their own personal value and counting the wins that they have in personal finance based off of these traditional vehicles, not understanding what the implications will be in the long run, at the end of the road. What is the goal? And when you get there, what will that look like? Do you know? Are you aware of that? Or does 100,000 or 300,000 or 500,000 or $1 million just sound so incredibly good to you that that's where you stop doing the math? That's where you stop doing the assessment. That's where the picture ends. Credits, roll the credits, curtains closed. That's enough for you, and everyone else can just figure it out. This is what it looks like when everyone else has to figure it out. Now, his brother's probably going, because his brother's wife's who wrote in. His brother's probably going, this is a really tough situation to be in. But over time, what he has in his mind is this economy is tough right now. Life is hard. And this would really help us to get ourselves in a different position. And so this becomes a wedge between these brothers. Make it make sense. So there should be different structure. There should be more provision. There should be more protection. There should be something that says it is not your fault that it's designed this way. But that's not what we have. We have people who are looking at how do I benefit out of this? Uncle Sam, winning regardless, doesn't matter. Matter of fact, even more if they're not properly structured, right? So it benefits even more. And then all of the brokers, all of the money market managers, they all won already on the fees. So even though this was designed for you and to help you through retirement and something that is transferable, and so you feel really good and secure about that, it's the other stuff that they don't talk to you about. They're not talking about that in your HR 401k meeting at the job, right? That you're not reading that in your packet. Who's covering this information? It's not just because this could be when you get older and when you pass on, when you're older and you at retirement age, have to forced to take distributions so that you can pay those taxes that they've been waiting for, right? It could also mean tomorrow, just simply tomorrow. And you had 50,000 in there, or 100,000, or 300,000, or 500,000, or however much you have currently sitting in this account, and it is sitting there unprotected. And there's some assurance that helps us sleep at night, thinking, well, it could just be transferred. And we stop there. And most people just stop there, because if they tell you what that means for your loved ones, you won't sleep. You'll ask more questions. They don't want to answer them because they don't benefit from any of the answers that they're going to give you. I'm going to stop there, but that's why I rant, because we have to see this stuff, and we have to start telling other people about it so that they can be aware. This is why this particular story, my heart just goes out to this family having to deal with, or any family having to deal with this right now.
So I think that just brings us to the last slide, right? And that is, why can't you? So just to kind of summarize things, if we're talking about gifting, there's two separate rules that we need to be aware of. One, it's general gifting, meaning I have a dollar amount, I have income, I have a brokerage account, I have savings that I want to be able to share, give to someone else. There are certain gifting rules associated with just gifting those dollar amounts to your loved ones or to charities. And it all starts with making sure you understand the limits. $18,000 and $18,000 and under, you don't have to account for from a tax perspective. But if you're gifting anything over that, you do have to account for it tax-wise. And if we're talking about gifting from a retirement account, that is a totally different structure, totally different rules that apply. And regardless of whether you're 59 and a half or not, meaning you're at retirement age where you can start taking those distributions from your retirement account, can you gift from your retirement account to a loved one? And the short answer to that question is no. But you can gift to a charity. But you can't even gift to a charity until you hit that age of 70 and a half. Why? What is it? Why is it like this? Goes back to who benefits. Uncle Sam wants his part. And if we're talking about tax deferred dollars, from Uncle Sam's perspective, before you give any money anywhere, they need to make sure they're getting their cut. So how do we avoid this? Like, what do we do to make sure that we're not put in this situation? Well, for those of us who have these tax deferred vehicles, we should be focused on how can we convert these tax deferred dollars to tax free dollars. What's that process? And we coined a phrase that is completely made up, but it fits. It's called Rothicizing, meaning I'm 50. I'll be 51 in 6 days. In 6 days, I'll be 51. So that means I've got about 9, almost 10 years before I can access my tax deferred dollars. Well, I can use this time, this 10-year period, to chunk away at converting those tax deferred dollars over to tax free dollars. And I can grow them during that instance so that by the time I do hit retirement age, everything that I needed to convert has been converted. And now I'm just growing tax-free profit from that point forward. Because converting from deferred dollars over to Roth dollars is simply a decision. There are other steps that has to take place, but it starts with deciding. So in doing so, I am now setting up generations to not be concerned about what Uncle Sam does or doesn't, or is or isn't required to have. Why? Because I've already addressed that. And now any growth on those dollars are growing tax-free. So that's one way. The other way is, and we talk about this a lot on this channel, it is, what are those vehicles that allow you to build tax-free income? That's where the secure compound interest account comes into play. So are you putting your money in a position to where you can start generating income tax-free or generating wealth tax-free? And regardless of what happens to you, whether you're here or not, how it's transferred over to your family is transferred in a tax-free fashion. That's it.
Well, there's a few other things. There's been a lot of controversy over people gifting charities, their wealth, to charities instead of to their families. And I think it's anybody's decision of where you want to put your money, what you want to do with your money. That's your business, right? I just want to do a quick recap. Mick Jagger, Jackie Chan, Mark Zuckerberg, Bill Gates, George Lucas, Gordon Ramsay, and on the new list is Jeff Goldblum. They've all declared or have donated the majority of their wealth to charities instead of to their families. I think there's
Love
a lot
that
of
for them.
it, completely love that for them. Obviously, they're on a different plane than most of us are, right? Would it be worth it to donate part of your wealth if you didn't think that your family would be responsible in how they spend it? That's a completely different conversation.
Man.
That's Zaid, he was in here earlier. I don't know if he's still tuning in or not, but he was saying that he brings his daughters to watch our live streams so that they can learn about some of these strategies. I think that's where it's at. We've had a lot of families tune in together and help each other level up. Like, look, I get this could be a snooze fest topic, but the earlier you learn this stuff, the better off we are. And here's why. We're not promised tomorrow. But what we learned tonight was that this particular commenter on our blog is seeking help because this is not a life insurance policy. This is not here's what I've left for you. There's a lot of red tape here, and they're going, well, we thought that this was an inheritance. We thought that this was just assets, and now we can go liquidate everything, and we can do what we want with this. You can't. Now, for some families, that's a good thing, right? Because there are some rules, and so you can't have it all at one time. Therefore, you can't spend it all at one time. But for other families, being able to understand how to get yourself properly structured or understanding where you can roll this over so that you can have more control. That's really what I wanted to talk about. But we do have some questions. And I'm glad that you had mentioned it before. Okay, let me bring them up here. Okay, well, no, we answered both of those. Okay, Antonia had a comment here. So I had a client in her early 30s making $90,000 a year, getting married to an engineer making high $170K a year. And her dad passed away and was taking RMDs, so she needed to take 10% a year. Hold on, right. Wait for it. Her dad had $1.2 million in his retirement account, and she was forced to take that amount and pay the taxes. Right.
Forced.
Right. She doesn't get to opt out. She doesn't get to say, no, later when I'm at retirement age and I need that income, that's when I'll do that and pay the taxes. Not right now. Not right now, because I'm trying to advance my career too. And this would put a damper on everything if I start making more money, pushing me up into yet another tax bracket, right? This is also where that capital gains increase and the unrealized gains increase starts to really make a difference because of the insane amounts of wealth that's about to be transferred from the boomer generation as they go, right? This is where people who are not structured and who don't understand these rules are going to find out. This is the F around and find out during tax season that this is your life, you know? And that's it.
Trillion with the T. 84 trillion is what that looks like.
Yeah. Yeah, that's crazy to me. And but this is why, regardless of the age of this mother, you know, to this family, she could have been not at retirement age when she passed. She could have been, you know, at RMD distribution. She could have, regardless, been either there or not there yet. So we don't know how that's structured or what rules apply there. What we do know is that her intent was to pass on an inheritance. Her intent was that her brother or her we're just going to call it the responsible one that she trusted could handle this, could have control and carry out her wishes. And in order to do that, you have to have control in the first place. And you just don't with these traditional vehicles. And that's why becoming self-directed is it's a movement. It's a mindset. It's a lot of decisions that add up to, no matter what happens to me or my situation or circumstances, the opportunities that come my way, I have control to be able to take advantage of them. That is so significant. Not only do I have control, I have protection. I have some structure here that is different from where the rules that everybody else has to follow. I can play a different game at this point because there are different rules that apply. So one, being able to roll over, people don't know, you can roll it over into a self-directed IRA. Absolutely can do that. You can, I'm going to stop there. So, because this isn't a promotion for a self-directed
It's not.
IRA or 401k. This is just about being properly structured.
And here's the thing. And some of these topics can be their own 3-hour live, because I want to make sure something is clear here, because I can't hear myself. Usually when I go back and watch these things, I go, man, I made that feel or seem a certain way. What I want to make sure is clear here is who's at fault in this process. It is not mom's fault. Mom did the best that she could do, and
Right.
she put her kids in a position so that they could have a better life. She is
Right.
not at fault here.
Right.
Who's at fault here? The kids are not at fault. The
Right.
brothers are not they didn't know what they didn't know. Mom didn't know what she didn't know. The people who are at fault here are those who said this is the vehicle that you need to be able to put your money in so that you can have that successful retirement. My issue is with those those employers who provided that tax deferred retirement account, those financial advisors who said, you know what, tax deferring those dollars inside that IRA, you're going to be okay because your family's going to love it. My issue is with that. And in addition, it's not the vehicle. The IRA isn't the problem. The 401k isn't the problem. You said it very, very well. It's the structure, and it's where you get it from. And the best thing that we can do is educate. The best thing that I wish that we could have done for mom is given her the information to understand that, hey, here's what you're creating for your family if you continue down this path. I got a presentation this weekend in Scottsdale in front of probably 100 real estate investors, where I'm going to break down how they can leverage their retirement accounts to go invest in real estate. I simply skim over, we should all be thriving and striving to be able to live in a tax-free environment. We should all be focused on becoming Roth. We should all be focused on building tax-free wealth. And I skate over it. I know I go over it very, very quickly, but it really deserves its own presentation, because the impact of us not being focused on becoming self-directed, the impact of us not putting our money in a position to where it can generate tax-free income, it has more of an impact than we are really realizing until we run into a situation like, hey, Uncle Sam wants their money.
It's not just Uncle Sam, though. This is also the credit card industry.
That's
This
it.
is the
You're
mortgage
right.
industry.
You're right.
This
You're
is
right.
everybody right
right.
now who is focused on being debt free. Like, it is such a
right.
priority, and imagine spending. People do this all the time. If this makes sense, imagine being on Amazon and you are spending 10 hours trying to find the deal, right? Trying to find the best product at the best price. And you might be saving a couple hundred dollars. And you've spent the majority of your weekend just scrolling, right? You're just continuing to look for the best deal. Or maybe you're driving around to different stores and you're price checking or whatever the case is, and you're trying to save yourself a couple $100. The same couple $100 that you had lost because you weren't out increasing your business, right? Or you weren't out making money because you're so focused using that time to save money. Now, here's the difference in a scenario over here where we're talking about. The amount of money that people are so focused on saving, they don't actually save, because where is it at? Where's it at? Where's all the money that you saved that you didn't pay into your mortgage? Where is it at?
The bank's using it.
They don't have it, because that money just gets reallocated, because even becoming debt-free doesn't help with bad decisions, right? But who is helping you shape those decisions? It really matters. And pay attention out here, because some people can only have can only bring you to as far as they can see, right? And to be fair, so that's where we are. We can only bring you to as far as we've come, right? So no love lost there. The problem is, though, that if you're just focused on the surface math and you would rather be right, you would rather have authority, you'd rather have views or subscribers or whatever the case is, you'd rather walk into the room at the party, the holiday gathering with the family, and you would rather feel like you are right versus being correct, being educated on the process. It's completely different. There's a lot of people out here who are so hyper focused on reducing their debt that they're doing the exact same thing that this being put in the same position that this one guy, that the example that we went over today, is in, where you can have an inheritance and you could also have nothing to show for it because it got eaten up in taxes. You can be debt free and broke at the same time. Both things can be true at the same time.
It's true.
What we can't do is not focus on on building wealth, how to build wealth, lasting wealth, wealth that will continue to compound. That's what we can't do. We can't skip over that and say, well, we'll get to that. Why? Because time is our most valuable asset. Time can work for us or it can work against us. And we have a way of structuring this so that it works for us. So why would we start later? We're not even promised later, right?
Pay yourself first.
Pay yourself first. Okay. So
one other piece I just want to highlight, and that is tax. I am a fan of paying taxes. I'm okay with paying taxes, meaning I would much rather pay the tax rate today on the money that I'm investing or using today. But I want the growth on my investment growing tax-free. So I'm paying the taxes today so I don't have to pay the taxes tomorrow. It's not I don't want to pay any taxes. It's not that I am not on board with not paying my fair share of taxes. That's not it. It's I don't believe it is to my benefit to have to pay whatever the tax rate is in the future because we know the tax rate is going to be higher. So the best thing that I can do is put my money in a position to where I paid my taxes today, but the growth, the money that I'm making in the future, the money that I'm putting away for that granddaughter who's not here yet, I want to make sure that they're in a position to where any income that they receive, they're receiving tax-free. So that's the key. It's making sure you're properly structured, that you're putting your money in the right position so that you're building tax-free income for the future.
Man, imagine putting something on layaway. Remember layaway back in the day? Who doesn't remember layaway, right?
Still exists.
Chris does it? Okay, I don't know. But imagine doing that and then you said, okay, now you go get your gift. You just got to pay the last payment. But by the time you got to the last payment, that last payment had grown to be as much as it was when you bought it. That is what it's like to wait and pass on these, roll these IRAs over into your kids' names. It is no different than doing that. It does not feel like a gift when you have to also bear the burden of the penalty that comes along with that. How to invest for yourself says, I hate the tax and interest paid. It's theft. We take all the risk and the government has their hands in your pockets, taking your leftover risk, hard earned money, I think is what he meant. I couldn't agree more. And I know that there are more things that we can do. We do a lot of things in terms of having tax shelters and tax strategies in that way. But there are other things that we can do. And the more you grow, the more the larger your income becomes or the larger your nest eggs become, also mean you have to deploy new strategies. So you have to always
strategies have to grow with you.
That's right. Yeah. I think, Mark, that's what Mark's talking about here. And we love it when you pop in here, Mark. The biggest problem is most financial advisors use one size fits all concepts, which is a plan for financial enslavement for many. Everyone's financial situation is different.
That's right.
Yeah, exactly what we're talking about. And the opportunities are different. And I think that's the part where if you aren't educated and you're not structured on how to take advantage of opportunities, understanding what opportunities you can take advantage of, then an opportunity could be looking you straight in the face and you don't even recognize it. Mm-hmm. That's the tough part. Here's the part that I felt was missing out of all of this. If you are removing money, call it gifting, call it what you want, put a bow on it, it doesn't matter. Once you remove that out of your machine, it does not continue to grow.
Right.
What does it do? Wherever it's going, hopefully it's going into a vehicle that will continue to grow. But we don't know because it's gifting, right? By the way, we were doing some fact checking earlier. We went on AARP's website to just see what they had on the matter. And I loved at the bottom of their page, it said, regardless of what age you are, you could always donate to AARP. You could give us money. We're a charity. Thank you.
We'll take that
Thanks.
$18,000 every year if you like.
Are you looking to gift somebody? Gift to us. Yeah. I love that they put that on there.
Equal opportunity.
Just give us the money. Okay, so that aside, I just that's the part that I wanted to point out is once you remove money from a machine, if it doesn't continue to grow, or understand how to structure yourself so that if you do leverage money, if you do need to gift somebody some money, you understand that that money that got removed is actually been copied, right, out of your machine, and it's still making money for you. That's the smartest way to do this. Back to the taxes, though, one thing I did want to say is we know that Warren Buffett paid less in taxes than his secretary. So there's no reason for us to be out here acting like we have to be paying her taxes and paying them in the same way she did. But so many people are because we just don't know what we don't know. We can all take advantage of strategies like Warren Buffett did. And we can get ourselves structured in a way that we were working smarter, not harder. We are truly creating generational wealth that is transferable, that allows you and them to have full control, and educate them along the way so that they understand what opportunities are and are not. We don't have to follow after these decades of advice on these vehicles and structures and strategies that were never designed for us to win. Never. We can do better. So, hold on. Thank you for watching this. Thank you. Thank you for watching this because I've been shouting this from the rooftops. Please go watch this documentary. He said, oh, I finally saw the retirement gamble. Watch it, folks. That will scare anyone straight. It's not just this one now. If you've watched the retirement gamble, go see their documentary on credit cards, how credit cards started and why they are allowed to be and maintain and continue to be so predatory. Watch that one next. There's also The Great Taking, which is someone's opinion with stats. They were on Wall Street. They were deep off into this. This is their opinion. It's called The Great Taking documentary on where we're going, where the economy's going, which is even more important that you get structured in a way where you have control and there's no one else who can keep your money. There's no one else who can come for your money or your assets. Getting structured in a way where you're protected is going to be more important going forward than ever before.
In addition, though, that structure is also about being in a position to be able to pivot. Meaning, we don't know what tomorrow is going to bring. We don't know what rules. To your point around the capital gains and those rules and laws being changed to benefit the government, so we don't know where we're headed. The key is, the question rather is, are you in a position to pivot if you need to pivot? If the dollar all of a sudden became de-dollarized, can you shift from wherever your money is today and move into precious metals? Are you able to do that? Are you spending leverage dollars instead of spending your cash? Because if you're spending leverage dollars, the dollars that you're spending are tax-free. So it's being liquid and being in a position so that regardless of what happens, regardless of how the rules change, regardless of who's in office, regardless of what adjustments take place, you are in a position to pivot when you need to pivot. That's where becoming self-directed, having control, being properly structured matters the most.
True. Dilly. Okay. Mark says, sadly, I've discovered hundreds of my tax clients were putting what would have been non-taxable dollars based on their tax bracket into a tax-deferred account.
Right, because we've been conditioned to do that. We don't know any better, and so that's where I think streams like this or lives like this are so important, because all it does is just shine a little light. It shines light on, you know what? It forces you to kind of dig in internally and go, what am I doing today that could be putting my family in a similar position? Right.
Yeah. And then it makes you start to wonder, like, even the people around you. I know a lot of people enjoy jumping in the chat and connecting with other people on a similar journey, because it's hard to have these conversations if your circle is not also having these conversations. This changes friendships. This changes a lot of relationships when you start to level up and you just can no longer subscribe to some of these justifications. They're going, hey, as long as we're all broke, right? As long as we're all headed in the same direction, whether it's just enough or barely enough or won't ever be enough, and we know that, but it's easier to agree to that today, so we can be comfortable or more comfortable today than being uncomfortable today and making sure that we have our stuff all together in the end, right? That conversation is really uncomfortable to have with other people. So sometimes we have to start changing the circle of people and that we hang out with, right? And that we surround ourselves with. The conversations that we start to have to be, this is the hill I'm on. Like, I'm not coming down there anymore. This is where I am. I'm not going back. I will pull you with me. Like, you can come with me, but I'm not going back. I'm not going to do it. For a lot of people, they simply don't want to learn. It is intimidating to learn. Let them know, if I can do this, you can. That's why I'm out here. If I could learn this stuff, you can, I promise. Why is it even more important? Well, isn't that true?
Oh, we talk about it all the time. It's not sexy. There's nothing sexy about this.
Yeah.
But if we can break it down into bite-sized pieces, it becomes a little bit easier to digest. And I think that's the skill set that you bring to this process. Is a lot of this information is so heavy that the visuals makes it a little bit lighter. The stories make it a little bit lighter. The examples of, you know what, I'm just like that person. I see myself in that individual. Maybe I can do this as well. I think all of that makes it lighter. And to your point, your network is your net worth, right? Or your net worth, however you say it. I think a community like this, maybe you don't have people around you that are having these discussions, but because you're here, because you're on this live, because you're in the chat, and what you hopefully are receiving is these little pushes that say, you know what, you can do this. This is attainable. This is within your reach. I had a conversation with Zakia today, and I think she got me kind of fired up just based off some of the actions that she's been able to take off just simply putting these small pieces into play. She's got her HELOC that she's working with, that she's able to leverage and do certain things. Like, it's just these small pieces that she's putting into play that's yielding success. And sometimes that's what you need. You need people around you that are doing the similar things, having the similar conversations, to know that you can do it too.
Yeah, and being able to just call in or book an appointment with you and just say, is this right, Donnell?
Right.
I know for a lot of people that has been extremely valuable too, where other people are out here that they would have to pay for that appointment just to ask those types of questions, or however they're structured is just different than what we're out here doing. And that's why we don't charge for calls or consults or any of that. People need help. They need access to information. And sometimes you can't wait a month or until it's convenient for somebody else. Not that we're available all the time, because we're not. Your calendar definitely books up. And that can be frustrating for people who do need to get a question answered right away. But there's email, right? There's text. There's a lot of different ways. We do have a couple more questions. I don't think we have any more in here. Okay.
Yeah, I didn't think we have other questions. Okay, go ahead.
Just a couple, because I wanted to address some of the ones that people had written.
Perfect.
When they wrote in. There's a lady who says, can I give my daughter $10,000 out of my IRA as a gift without paying taxes, or is this considered a distribution out of my IRA account?
So, assuming mom is at retirement age, Can she take a $10,000 distribution? She can. If it's a traditional IRA, she's going to be taxed on that $10,000 distribution. But can that dollar amount then be gifted to her daughter? Yes, it can, as long as it's under that $18,000. But can she gift directly from the IRA to her daughter? I think what we've learned today is you cannot.
Okay. Another one says, I've been researching gifting some money from my 401k to a friend or my brother-in-law. If I give $17,000 to one of them, will taxes have to be taken out for either person? And will this count as income for either person? From what I can understand, you can gift in 2024 up to $18,000 to someone without paying taxes, or it counting as income for either person. Is this correct?
And again, notice these are all similar questions because there's this influx of income and cash available that we just want to be able to share and provide and support while we are still here. So can I take $18,000, because in 2024 it is 18,000 out of my 401k and gift it? And again, you cannot. You cannot, because your 401k is designed to benefit you. So if you want to take a taxable distribution, not a taxable and penalizable, but a taxable distribution because you're at retirement age, take that taxable distribution of $18,000 or less and then gift that to your family member. You absolutely can. But what if you took that $18,000 distribution that was taxable, that you paid taxes on, and then transition that dollar amount into a vehicle that is producing tax-free income, that is capable of producing tax-free income, like a secure compound interest account? Meaning you take that $18,000 and you get it working. You put it in a machine, and that machine can start generating income at some point. That would be better than just simply giving the $18,000, because it is going to be a taxable event for you. And you can absolutely gifted, as long as it's under that $18,000 to anyone. But I would suggest putting it to work so that you could actually produce tax-free income for life.
And will it be considered income for either person? So you said it would be considered, it can be counted as a distribution, but would it be considered income to the person receiving the gift?
It would not be considered, if it's under that 18 or less amount, it would not be considered income to the individual receiving it. So they would be able to receive it and use it for whatever we like. There's no tax implication, nor it would not be a taxable event for that individual, nor would it be received as income.
Okay. There's another one, and it's about grandchildren and wanting to gift them through the IRA gifting, and they name the same $18,000 a year in 2024. Do either one of us have to pay taxes? We've already answered that question, but there's a different ending to this one. Also, is there a limit on how many gifts I can make in a year?
Perfect. So let's say you have 5 grandchildren, and the objective is to gift that $18,000 to each of the 5 grandchildren. You absolutely can gift to each individual up to that $18,000 mark, and it not be deemed a taxable event for them, or from a gifting perspective, you're able to gift that $18,000 to each individual and not have to pay the gifting tax. Again, if this money is coming out of a qualified account, you have to pay taxes on that $18,000. That is still a taxable event, but the gifting of the $18,000 to those individuals is not. And now, how about this? Let's say you and your spouse wanted to gift $18,000. So 18,000 times 2 to each of the 5 grandchildren. You absolutely can do that. So again, what would you owe taxes on, though? The distribution out of the 401k, you would owe taxes on the distribution out of the 401k. But the gifting of the dollar amount, 18,000 each from you and your spouse to each of the grandchildren, is absolutely something that you can do.
Okay. All right. Well, some of these other ones, I think the 401k questions we could probably save for another stream, just because we'd have to kind of peel back some of those layers. So if you write in and you have particular questions and we can answer them live, we really appreciate the opportunity to do that. It's best if you're here live, because then if we don't understand the question, then you give some backstory or clarification that really does help with that. So, man, Sequoia, she's on it here with this banner, saving us all one banner at a time. Appreciate you. Okay. Since you guys, the people I have brought this to, knowing they are as bad financially as I used to be, they put their vacations and personal current goals ahead of their future. Yeah. Yeah, it is frustrating. And he says he loses so much sleep over them. It is really frustrating to watch people. And here's the worst part about this. It will be 10 years, probably, until they wake up and realize, oh my gosh, I should have listened and now I can't go back 10 years. So you know what, Zaid, can you help me? Since you've been doing all this stuff for 10 years, can I piggyback off of all of the information that you have? Because now I'm in a rush. Now it's an emergency. Now, I say that not because everybody feeling that way right now could have been told 10 years ago to do something different, right? And maybe they didn't listen. Maybe they didn't get how urgent this information really was to implement. But there are a lot of people who are in an emergency situation. They are just realizing, like, I can't go back and I don't have anything right now. Keep trying to wake people up. If you care, it's not your responsibility. It is not your job. You shouldn't feel guilty if you don't, because you focus on you. As long as you're focusing on you, that's fine. But keep trying to wake people up, because it had to have been somebody, however you got here to learn this information. There had to be something that was said, or someone that might have shared it with you that got you educated, and now you're in the loop, right? So keep sharing, keep caring. That rhymed.
Bars.
There was something else about that, but it is sad. It's sad to know that, while other people are making different decisions and you're going, that kitchen rehab ain't going to help you, sis. That new bathroom is not going to help your future. And lots of mindsets around what stuff and things do, lifestyle choices, YOLO types of attitudes on, well, we only live once, so we might as well. And I don't think that that's particularly that people have to not have fun. People don't make memories, don't go do things, don't enjoy life. I think there is a balance. Working smarter, not harder helps you achieve that, though, and having the right tools and the right structure allows you more playroom to do those types of things too, because you're not missing out, right? When you become your own bank, you're not missing out. So it's not going on a credit card, and that interest isn't being paid to somebody else. Interest is being paid back to yourself. Should you choose to go and do something, that's completely different, right? And these are options to all of us. So we really appreciate you guys being here. Let's see here. I'm trying to go through. Brenda, we're still here. We're still live. She said she's traveling for work and the extended hours robbed her. Well, we're glad you're here, and we're glad to see you in here. And thanks for jumping in the chat, because we don't know who's watching unless you jump in the chat. For all the people in the back, like this video. Yes, please like this video. Subscribe if you're new here. That makes a difference and it helps us grow. And if you're watching the replay, leave a comment. We love that, because it also helps us to be seen by more people. Mark, you are so sweet. By the way, somebody asked us, so do I need to tip you guys for on the call? Remember, he's like, so how does this work? Like, you don't just do this for free, right? I need to tip you guys? Because I think they saw people leaving tips on the live stream. You don't have to tip us, but we appreciate
it. Absolutely,
we appreciate it, of course. Yeah. please reach out, Mark, because we would love to connect with you and we love to grow our community. So if there's something that you do that would add value to this community or something that you know, that's really what the Facebook group is for. Is we're not in every industry. We're not active in all of these investment types either that you can invest in or be structured in different ways. So everyone's situation is different. And that's where you get the value is building your community up to be able to just throw out a question and say, hey, has anybody else banked with this bank? Has anybody else applied for this particular product with this lender? Has anybody else have experience with this particular thing? I had an opportunity come to me and I just want to pick your brain type of thing on what your experience was. That's really the value in the Facebook group. So jump in there too. K Session says, how does the TSP work in regard to gifting? It's a great question.
So TSP, 401k, 403b, government 457 plan, they're really all the same. They all function in the same space. They're all considered pension plans, and you can add a beneficiary. But if you're talking about creating an inherited TSP or an inherited 401k, you can't. What you would do is you would transfer those funds into an IRA, and you can then create that can then be distributed as an inheritance. But a beneficiary kind of works the same way. So your TSP, I know for a 401k, you can identify or a beneficiary for those dollar amounts. And I don't know, from a military pension perspective, I think it's just you and your spouse. And what I've got all sorts of questions running through my head as it relates to TSP, but the way I understand it is the TSP functions very similar to the 401k or the 403b, meaning it functions as a pension, and so therefore you can identify a beneficiary. And so, as it relates to gifting, you cannot gift directly from a TSP. You would have to transition those dollars into an IRA and gift from there. Just so we're clear.
Just a reminder, though, also one of those rules was that you have to know what your governing documents are. So just because you work at this place, somebody else works at this place, they can do things with their TSP, their 403b, 401k, IRA through that employer does not mean that there weren't rules established in their agreements in the contracts that say, nope, you can't here because that's what we decided that you couldn't do. And you didn't know to even look for that because the opportunity hadn't came about yet. So I think that's something else to go look at your contracts, go look at your documents and go find out. If you have plans from previous employers, don't roll them into your new one. Take control so that you don't have to know what these rules are because you have full access. You have checkbook control and you can do what you want, when you want, with who you want. Almost. Oh, but what I love about the example that we went over today was you always say when you're talking about disqualified persons for a self-directed account, you always say, notice who I didn't say was a disqualified person. Your brother, your sister, right? And this is a particular case where it didn't matter that they were brothers, but if they were able to have been structured in a way where they had full control, this would have been a no-brainer.
Exactly.
On top of the fact that him and his wife could have been commingling the funds, right? From their retirement accounts if they were self-directed. There's just so many different benefits and things that you can't do because they're siloed into, nope, we have to focus on the fact that you are going to pay us more in taxes later than you would today. And we love that. We love that for us. Love it for us. That's what Uncle Sam is saying. We're just going to focus on that.
If I could leave with any question to ask, start with the question of who benefits from the current from the current structure that you have? Who currently benefits today and who benefits in the future with your current structure? So whether we're talking your company's 401k, your company's 403b, your TSP, doesn't matter the vehicle, it could be your Robinhood account. Who benefits from the way it's structured today? Answer those questions, because I think what you'll learn is there may be a way to structure things differently so that you can make sure that the true beneficiary of that structure is you. Again, that goes with your mortgage. your retirement accounts, your 529 plan, your HSA, your high yield savings account, your Morgan Stanley account. It doesn't matter the vehicle. It's just simply asking the question, who benefits? Who benefits today? Who benefits in the future? And then if you identify some flaws or some gaps in that structure, then it's how do you make the right adjustments so that you can make sure that the beneficiary of that structure is you and your family. I would just start there.
Yeah. Well, and we'll be rolling out as soon as we're done with our process on the people who we have vetted on where to go get a trust from, and that we know could support our community in that way and that we trust. So we'll have that up so we can further discuss that. Maybe we can have them on so we can discuss that further too. Also, what else do you guys want? We have obviously picked today's topic based off of the comments and the many comments that we had in the blog. We sometimes pick comments based on what we're seeing a lot of questions, whether if it's people who are from the calls that are booked. Let me get, where is that? Selfdirected.info, anywho, is where you would go if you want to book an appointment. They're completely free, and you just pick the appointment that applies to whatever the topic is that you would like to talk about.
Yep. When you go there, click on the calendar. It's pretty simple. And you have options. You've got 15, 30, and I think 45-minute options available to you. So.
Yep. So be sure to do that. I don't know if we're giving away a boat tonight. I don't see anybody.
Yeah, I'd say we do it on Sunday. Let's get out of here.
Okay. All right. Well, we've got some changes coming up, and we're pretty excited about those. Just different ways that we can serve the community and make sure that we are doing our best out here to serve in all of the areas that we do. So we'll be posting some polls this week to get your feedback on making those decisions for us, just in times that we're going live, or other resources that we have available to us. So we're really looking forward to your feedback. Okay, so we'll be here on Sunday until we make changes. We're still Wednesday and Sunday, 6 p.m. Pacific Standard Time. You laugh every time I say that, but now it's just like a rolling joke. You had to been here January 29th stream if you want to know why he laughs every single time I say that. Okay,
I think you're cute. That's why I laugh.
We have a ton of free resources that we want you to take advantage of, and we're going to show you in just a moment. But we like to end with, if you didn't come from a wealthy family,
you can make sure a wealthy family comes from you.
So stay tuned.
Stay protected.
Stay focused.
Stay connected.
I'm Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
In order to do that, we have a ton of free resources and an amazing community growing in the background. And we are completely grateful for all of those who spend their time with us. Time is the most valuable asset that we have. And we're so glad that you've spent yours here with us. We'll see you Sunday. Thanks for tuning in, guys. Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.